Today's video is going to be all about inflation because we are starting to see it. Gas prices are up, home prices are, everything's up. And so the question we're going to ask is this just here for a moment or is this just the beginning? And we're going to sit down with my partner, co-president and CIO of Commune, pretty much the brains. He's our brilliant one. And we're going to talk about what's in front of us. Is it here for the long term? And if so, how do we prepare for it so that we can ultimately succeed financially through this time? Thank you guys, and we'll get into the video. Okay, so we have been talking probably over the last year or so about inflation internally. And I was personally a little bit surprised about your opinion of what was happening because you were kind of saying, look, I know everybody's screaming inflation, but I'm not seeing it. So let's start here. Why were you not seeing inflation coming when it felt like everyone around us was screaming, it's coming, and it's coming at a high rate?
Yeah, good question. So the reason why is, the people who are crying, inflation is coming, they would point to the increases in the money supply and say, okay, we're printing all this money, that has to cause inflation. That's partly true. There is a sort of a causative effect there, but there are things that happen in between or have to happen in between printing the money and inflation that weren't happening. And I'd say probably the easiest way to summarize that is, looking at where did the money go? If it doesn't make it into consumers' hands, they don't have the money. Changing the money supply has no impact on what you have available to spend. Then that doesn't really cause inflation, at least not widespread consumer type inflation. We did see inflation in some things like asset prices and the places where the money was going, you saw impact from that. But it wasn't making it to the places where it needed to go in order to cause widespread inflation that would be seen in the CPI type statistics.
So then is that kind of what we saw in 2008 and kind of everybody screaming inflation and we didn't totally see it? Same thing at play, it just money didn't get in the hands of the people?
Yeah, that's exactly right. So same thing was happening in 2008 where it was a little bit different at that moment, when the Federal Reserve started, their quantitative easing programs and things like that, and people were crying inflation. And, you're in a deflationary environment, causing some inflation just gets you back to zero. And so, in that scenario, the goal was to create a little bit of inflation to keep it from going negative. So, you had that factor. And once again, same issue where the Fed, as they were doing their programs, they were also looking at Congress and saying, monetary policy isn't going to be enough. We need to fiscal stimulus. We need Congress to, start sending money, checks to people. We need, government spending, various other, things that only Congress can do. The Fed can't do those things in order to really combat the deflation that they were dealing with. And of course, at that point, 2008, Congress was locked up. They were not willing to actually take any kind of action there, at least no significant action. And so, there really wasn't much of an opportunity for that inflation to, grow in any meaningful way.
Got it. So, what is different about right now than 2008? Like, seems like the money got in the hands of the people. Seems like we're creating way more money than we've ever even thought of before.
Yeah, so...
Because everybody says, this time's different, dude. This one's different.
I disagreed until last week. And, what's changed here, yes, there was some money that made it into the hands of the people, but for the most part, that was just a replacement. People didn't get more money than they had before. They were, for most people. So, again, you didn't have a change in your spending patterns. You didn't have people suddenly going, hey, I can afford more. You think about back to, I forget how long ago it was, you did a video on inflation and the cause of inflation being changes in supply and demand. And that was right on. So it's not, the money supply doesn't affect inflation unless it first affects supply and demand. And so, when you view it in that context, if you all of a sudden have more money to spend, well, you start buying more stuff, or you buy more expensive stuff. Your tastes change. And if everybody does that at the same time, well, prices move, because if you change the demand for things, but the supply didn't change, we still only have, this, we all suddenly want, nicer houses, but we didn't change the number of houses out there. The price has to go up until finally people start backing off and going, not worth it. And so changing the money supply, if that money makes it into the hands of consumers, and now all of a sudden all those consumers go out there and start saying, well, I want to buy steak instead of potatoes. Well, the price of steak is going to go up, and so on, unless we're producing more. And so that's another factor. Changes in the money supply can actually be deflationary if it affects the supply side. But what we had happen here in this last year is you had a shock. You had two shocks that happened. One was a shock on the demand side, the Fed and Congress increasing the money supply and putting the money in the hands of the population, and a shock on the supply side, fewer people working, less stuff being manufactured, so that created an inflationary environment. But that's temporary. The money on the what's being handed to people, that eventually goes away. People eventually go back to work and start manufacturing again, and the economy should kind of right itself. And that's the story we're hearing from the Federal Reserve and a lot of people on Wall Street right now. When they talk about inflation, they talk about how it's temporary. Yes, we're going to see a little spike in inflation, and then it'll fall back down as we get back into the deflationary pressures that we've been dealing with before. And I think that's probably true. That probably is what happens. We kind of go out there and forecast, what are the range of possible scenarios. That's the most probable scenario. But we're seeing one other factor that started to kick up here, and that's wages. There's you probably saw the jobs report that came out a few weeks ago, and how it was this massive miss. Everyone was thinking that you'd probably see upwards of 1 million new jobs created, and the number came in somewhere around 200,000. So that's big miss by forecasting standards. And all the analysts were trying to figure out what just happened. How could we be off by that much? And the conclusion was the jobs are out there. You look at the job posting sites and all the recruiters out there. The jobs are out there, and the problem isn't on the availability of jobs. It's on the willingness of people to take those jobs. And sort of the consensus was you have a whole lot of people that are receiving more in unemployment than they would make if they go back to work, and a whole lot of people who just are afraid still to go back to work. And so the response by companies to that, you had a couple of things happen there. You had the Commerce Department that came out and said, hey, Congress, time to kill the unemployment benefits, or start backing those out, and at least remove the financial incentive not to work. And at the same time, you had companies like McDonald's that announced, hey, we can't wait. We're going to start increasing our starting wages to try and entice people to come back to work. Well, that's inflationary. When we look at the money supply issues, that's kind of a secondary factor in terms of my analysis. But when all of a sudden your entry-level jobs start paying more, well, that kind of spills over into everything else. Why, take a high-level job at, a wage when you can make the same amount with less responsibility? Or, stated differently, if an entry-level person's making, $15 an hour, then that person's manager is going to ask for a raise too. And before you know it, the entire ladder just, moved up a little bit, and we still have the same amount of product being produced. Everybody's making a little bit more. The price level just increases.
Okay, so let me try to break this down. What we're seeing right now with gas prices going, everything going up, right? That is caused by the supply chain being constricted, and as introducing more dollars into the system, there's going to be a short-term inflationary moment that people are expecting. But what you're saying, is that correct? But what you're saying is people aren't going back to work, so that the businesses are going to have to raise the either minimum wage or bring wages up, which then cause inflation, right?
Yes.
Okay, so now my question to you is, we've always been told that raising minimum wage does not create inflation.
You're looking at the wrong time periods.
So break that down.
Yeah, so if you're looking at, okay, we raised wages, minimum wage increase went into effect today. All right, what's the inflation level for the next 12 months? It's the wrong number to look at. It takes time. So you increase minimum wage today, okay, there's a small part of the population that benefits from that. And they talk about the wealth transfer effect of that, and that's true. It does do that for a time. But like I mentioned before, the manager now asks for a wage increase, and all the way up to the CEO, everybody wants to make a little bit more, and before you know it, everybody's making more money. Again, we didn't change. If we didn't change the amount of goods being manufactured, and we didn't change our productive capacity in any way, your supply was unchanged. The only part of that that moved was the demand side, and so your price level has to increase. But there's a lag there, so you got to look out more than 12 months to see it.
Okay, so then let's say that becomes a possibility. What type of inflation are we talking about?
Yeah, good question. So most people are pointing to inflation in the U.S. saying, okay, we think, Fed had a target of about 2%, and we should talk about the change they made on that. But they had a target of about 2% inflation, and the sort of consensus, if there's a wide range of projections out there right now, but people are kind of saying, hey, this 4% number that we're seeing right now, that's probably, 4.5% is probably where we see inflation go here over the next 12 months, and then falling back down to, 1.5% to 2.5%, depending on who you ask after that. Those aren't big numbers, okay? And so, all the people who are, crying, get out of bonds, this is going to be a nightmare. 4.5% is not a nightmare. That's, that honestly, you probably don't feel that. But especially if it drops back down as being predicted. And again, I think those are reasonable estimates. And if we're talking base case, there's a lot of things that can mitigate the wage pressures that we're looking at right now. If all of a sudden those unemployment benefits are withdrawn, and if McDonald's bumped up their minimum wage, and then next week they say, oh, never mind, we don't have to do that anymore, then it's a non-issue. But the longer this persists, the bigger the problem becomes. And if we're talking about a small move in wages, let's call it, let's say small is 10% move in wages, and that's spread over a number of years, it's probably not an issue. 10% right now, and all of a sudden everybody gets, the faster that transition happens, the bigger the problem is. Also, the other factor is what's that do to people's expectations? Inflation expectations have a sort of a self-fulfilling nature. You think about what happened with, a year ago, people, toilet paper in the market, okay? Everybody expects, hey, there's going to be an issue here. And all of a sudden, everybody starts hoarding it. Well, one of two things has to happen. Price has to go up, or they have to, set quotas and limit your ability to buy it. Well, they chose to do the latter. And the consequence was you just couldn't get it. If they had let pricing kind of run its natural course, you would have seen price on that skyrocket. Well, same, that's kind of a micro example of what happens across an entire economy. So as people start to demand more stuff, if that change happens very gradually, well, we reallocate resources and, price doesn't really move very much. If it happens suddenly, prices move by a lot. And when people start to expect those prices to move a lot, then they start to modify their behavior. They start to buy more now, expecting that it's going to cost less right now than it's going to cost a year from now. We're seeing that happening in construction, with lumber prices and things like that. They started to back off here recently, but you had a lot of people who are in the development business starting to buy their materials early because they were worried, steel prices are X. If, steel price goes up another 40%, then my whole project falls apart. And so they would buy their materials early to make sure that doesn't happen. Well, that just puts more strain, on the system, and so prices, move even further. So the expectation piece of that again becomes self-fulfilling. So the longer this, these problems that are contributing to inflation right now, the longer they persist, the more those expectations become a factor.
Got it. What are some of the moves that the Fed has to stop this? You kind of mentioned one, try to incentivize people to get back to work, or maybe some of the help they're giving for unemployment, they start, easing off. Do they have any other moves?
You have Congress and you have the Fed. Okay, so fiscal policy, monetary policy. Fiscal policy is just the legal system, what the government is spending and what our tax system is, et cetera. So Congress has the most power right now. And the big issues or potential issues are largely on the fiscal policy side. So if they were to start withdrawing unemployment benefits, if they were to raise taxes, if they were to, all kinds of things that they could do to slow this down. There's not a lot of political will to start removing those supports at this point. There's going to be some increases in taxes. I think everybody's expecting that, and that'll slow down the effect somewhat. On the monetary policy side, anything the Fed puts into the system, the Fed can take away. So when they're printing money by quantitative easing, things like that, they can take that out of the economy just as fast as they put it in. There are some problems there that make it to where there's question about whether they will. If the Fed starts to remove its supports, interest rates start to rise, and liquidity in the system starts to evaporate, and that can have some real consequences as well. So the issue isn't whether they have the ability to contain inflation. It's more of a question of do they have the political will to do so. And that brings us back to the conversation about changes in Fed policy. And up until recently, or I should say in the recent past, Fed policy has been targeting this 2% inflation number.
Which they've come up short for a while, right?
For a long time, yeah. We've averaged really ever since they stated that objective, they've never really there have been a couple of years where they've hit it and exceeded it, but by and large, on the average, we've been well under for a long time, about the last 14 years. And so at the beginning of the COVID epidemic, they announced we're not worried about overshooting by a little bit. Really, we want an average 2% inflation, and we'll go under as long as we're kind of hitting that average. So that was a change. And then here very recently they came out and said we're more concerned about the employment picture than inflation. So the Fed has a dual mandate. They were created to do two things. One is sustain employment, make sure that there's sort of a natural rate of unemployment that exists, but just from people moving jobs, and we call it frictional unemployment. They want to be as close to that as possible all the time, and there's going to be variations as we go through economic cycles, and they're constantly trying to figure out ways to tighten that up. Their second mandate is a stable price level, or keep inflation under control. And sometimes those two are in conflict, and trying to keep people at work might mean stimulating the economy to the point that inflation becomes a problem, or vice versa. Trying to keep inflation under wraps might mean policies that make it hard for employers and cause unemployment to tick up. So there's always this question of when faced with that decision, what do they do? And when they had a stated 2% target, okay, we know what they're going to do. And here recently they're saying, okay, we're now more concerned about the employment level than inflation. They've just told us what they're going to do. So if inflation starts to tick up, that's a cause for concern.
Okay, so let's say inflation goes high single digit, maybe even double digit. When's the last time we saw that? Around the 70s?
Yeah, 70s, and peaked in 1980.
Okay, so in that moment, if we're going back in time, what did people do? How did people combat that type of inflation?
If you are invested, so two different kind of perspectives we could take to that question, as a worker or as an investor. I'm assuming you're asking from an investor standpoint. As an investor, certain types of investments are very sensitive to inflation. Generally things like bonds, where you have a fixed expected return that doesn't change as inflation changes. Those are going to do relatively poorly, whereas things like let's say multifamily real estate that we're involved in, your rents rise. Inflation goes up, your rents go up, and there's going to be blips along the way. Prices are going to move along the way, but in terms of your cash flow, as inflation goes up, your cash flow rises, and you come out in basically the same position. Plus you get some growth from population growth and things like that. So if you're looking at it from a long-term lens, then if you're invested in those types of things that where the pricing of what's being sold or the service that's being delivered can adjust with inflation and the return can adjust, those are the things that you can be invested in to combat inflation. But important to note, prices do adjust along the way. So as inflation expectations change, you hear a lot of people talking about equities are the place to be, because for that very reason, the products you're buying cost more. Well, the companies are making more, and so that is the price of what you're invested in grows as inflation grows, and that's true. But first thing that happens is as inflation expectations change, your entire pricing model changes. If we're looking out there and saying, okay, well, 2% inflation, government bonds should be generating about a 2.5% yield. Well, I need a risk premium if I'm going to take the risk of investing in stocks. So, 7% return on stocks makes sense in a 2% inflation environment. Well, change that to a 10% inflation environment. 7% expected return does not make sense anymore. Now I need a 15% expected return or something like that. Your prices have to adjust for that. And so, the first thing that happens is, stocks dive. So, be ready for that. If you're expecting, if you are looking at the inflation picture and saying, I'm absolutely convinced inflation is coming, stocks might not be the place to be yet. Wait for the time and then buy. But, of course, that's not the conclusion. We don't, think that it's that high confidence. But, so from a long-term perspective, those kinds of things can be good. But from a short-term perspective, just be mindful that those prices do adjust, so you need to manage liquidity.
So I guess the follow-up would be in the 70s, early 80s, and you kind of answered it, but I want you to kind of touch on it. What investors did bad during that time and what investors did good? Like you talked about the stock market falling out. I imagine the investor that did poorly was the one who panicked, sold, went to cash, and then inflation chewed it up, right?
Yeah. So the people who had to sell as those prices adjusted were the ones who got crushed. And two reasons people had to sell. One is just panic. They expected, hey, my stock should do well, and all of a sudden they're not, and they sell because out of fear. Okay, you realized the downside and didn't participate in the recovery. So that type of investor does very poorly. The other type of investor that does poorly is the investor that's forced to sell, and typically that's due to leverage. So you think about, the real estate investor that has a, you talked recently about the Burr strategy, right? Okay, well, you maximized that leverage. It doesn't take a big downtick in prices to wipe out all of your equity. Well, if you have a loan that matures during that, during that time while your equity's on the downtick, you're in trouble. So you're going to have to sell, and if there's any equity left at all, the buyer's going to probably be the beneficiary of that. So the people who do well are the people who have the ability to be on the buy side, who have the ability to think long term and be strategic in their moves. The people who do poorly are the people who are forced into that selling position.
What are some of the, part of this is speculation, right? What are some of the things that we're doing to prepare without making a decision too soon, I guess you could say?
Yeah, so some of the things that,
is that the right question to ask?
Yeah, it is. And it's a hard question to answer without going really deep into the weeds.
Okay.
So when we think about how we manage and how we manage money in general, we take, the word holistic is so overused, I hate it, but it is a holistic approach. I mean, it's your money has a purpose, right? And its purpose probably isn't maximize return. If your purpose was purely maximize return, you probably wouldn't ever make bad choices. Fear and greed wouldn't be too big of an issue. We get afraid when we see the markets go down because that's my retirement or my house that I was planning on buying, or that money means something. Invest with that in mind, okay? And so if my money is about my retirement and I think inflation might be an issue, well, okay, that might trigger me to buy some gold or buy some real estate or something that is going to provide some benefit in the event of inflation. But I need to recognize that that's probably not, going 100% in those things also creates some very real risks. And so I want to kind of be measured in how much of that I do. Buying gold, for example, we bought golds in our stock portfolios here in this last week, but it's more of an insurance policy, right? If nothing changes, if the inflation picture, if the mitigating circumstances carry the day and the inflation doesn't run away on us, then the gold's not really likely to do very much for us. If anything, it's probably going to go down a little bit. Well, if that's 2% of my portfolio, that's not a bad outcome. It was worth doing. If it's 100% of my portfolio and stocks run away and bond yields stay flat and I give up a year of earnings because the inflation I was expecting didn't happen, well, that's a bad outcome. So what we do in light of all of that is structure our portfolios with context, and we're not about pursuing highest return at all costs, go with the burst strategy, maximize leverage, and whatever happens, throw the dice. Again, this money means something. So we're expecting an inflation risk. All right, if we're going to have leverage, I want long-dated maturities. I want to stagger those maturities to make sure that I don't have a catastrophe situation where all my debt comes due at the worst possible time. I want to have cash flow built in there. I don't want to buy assets where I'm running at a negative. California residential real estate for a long time goes through these cycles where you buy a house and you rent it out, and you're going to be paying more on the mortgage and property taxes than what you're getting in rent. Well, if you're expecting prices can do nothing but go up, okay, maybe you're willing to take that risk. If I'm expecting inflation, maybe not, because again, you have a concern about what happens in the midterm. So manage your liquidity, manage your positions to where whatever happens, you're positioned to profit from what you think is most probable, but you have some of the hedge in there for those outlier events that could happen, but would be catastrophic if they did. And inflation is one of those things. If inflation were to run away, again, 4 or 5, even 6% temporary inflation, non-issue. Double-digit inflation that lasts a decade, like what we had happen in the 70s, that's an issue. You have a massive amount of purchasing power that gets eroded there. So we want to be positioned to where we can again, be strategic during that time as opposed to reactive.
Got it. And for our viewers that don't have people helping them manage their portfolios, DIY, getting started, how should they be going through this? Is there some kind of action steps for them? I think outlook and just knowing what you're up against so you don't make emotional decisions. But what can we leave them with in case we do see the possibility of higher inflation?
Yeah, good question. So understanding what you're investing in is really important, no matter whether you're talking inflationary environment or any environment. Get as much education on it as you can. And when you see prices move, don't worry about that. Okay, if you're positioned to where the world doesn't end, I'm not a forced seller. I'm not leveraged. So whether we're talking stocks or bonds or real estate,
or last week crypto.
Yeah, crypto's a different thing. But if you're not a forced seller and you're in an asset that has intrinsic value, you're going to come out okay. So be looking forward. Don't worry about what is the price today. That's noise. Be looking at what's this worth 10 years from now. And so if you're an investor in, I don't know, pick your company, Coca-Cola, you may like their product, you might not. But if inflation ticks up, their prices are going to go up, and they're going to be just fine, unless something other than inflation happens. So don't worry about today's price. It'll do fine. If you're in a stage where you're withdrawing cash from your portfolio, either you're in retirement or between jobs, whatever, totally different picture. You need to be thinking about cash flow. You need to be looking at where am I going to, if prices go down, how do I get my cash flow without having to sell anything? And be prepared for that. And so there's some good rule of thumb metrics that are a great starting point. have 6 months worth of cash flow in cash. Give yourself time for investments to run their course. If you're, we use a tool we call the asset balance matrix, which is really nothing more than sort of a formulaic approach to dealing with this question of making sure that you have cash, you have bonds that are going to mature in the timeline that you need your cash flow. And then you have your longer, less liquid investments where market goes down, we're not worried about it. So approach it with that mindset. When you're dealing with real estate, things like that, buy cash flow. As long as that doesn't go away, and as long as you've got some diversification, there's always the property specific issues that can come up and kill your cash flow. But if you've got a little bit of diversification, and you've got good cash flow, you're probably going to be okay. If you're expecting inflation, and you're concerned about that, maybe stay away from, the long-term fixed rate leases. If you've got a company that, or say a retail property or an office building with a 20-year lease with fixed escalations, that's probably not the type of property you want to own if you're concerned about inflation. But something with shorter term leases like multifamily, self-storage, those are they're going to move with inflation.
So I love that you use the example of using gold as an insurance policy. But I've known you a long time, and I've had so many conversations with you about gold and how you have always had a bad taste in your mouth when it comes to gold. Did you change? Did you pivot? What happened?
No, I still hate gold. I don't see it as an investment. Okay, and so when we talk, typically the question when it's directed to me is, what do you think about investing in gold? Gold's not an investment. It feels like hoarding when I own it. And so, because you're not, like I've always said, it's not productive. Okay, any money I put in gold is going to sit there and do nothing. The gold's going to sit on the shelf, or it's in a safe deposit box or wherever. No one else benefits from that. Okay, I would greatly prefer to invest my money in a way that is productive. It's the whole doing well by doing good thing. Okay, if putting my money out there in an investment makes other people's lives better and I can profit from that as well, that's how I want to invest. And long term, I'll do way better doing that than by sitting, hoarding gold. So my attitude towards it has not changed. Having said that, there are few things that, if inflation does make a big move, and that's a big if, and that's I think that there are things that are happening that can generate inflation that might be, I heard someone, I don't remember who, used the word sticky, and I think that's the right word. If that inflation turns out to be sticky, if we don't have the political will to do what it takes to keep that under control, gold's one of the few things that gets that short-term bump that I can then sell to buy into the other things that have gone down. So, I view it from that context. It's a diversifier, like I said before, an insurance policy. So, not the kind of thing that I want to be in long term, but and I'm not usually a tactical trader, but we're dealing with a risk here, and I want to make sure that our portfolios are addressing that.
Okay, so I'm not giving investment advice, I'm not having you give investment advice, but the takeaway that we don't want people to have is go buy a ton of gold, right?
No, yeah. Yeah, in case you missed it, our base case is, or our most likely case is, inflation's not an issue. But again, there are certain things that we're watching very carefully that are, we refer to it as tail risk, the risk that the unexpected should happen. And there are some things that are happening that make the probability of that a little bit higher, and high enough that it's worth some attention.
just that last thing, just as I'm thinking about it, those are going to be all the short videos we send out on our social platforms. There was so much value there. So I appreciate you. I'm incredibly grateful to know you and be able to participate with your genius brain. For everyone else, thank you for being here. Would you mind leaving a comment on what you guys thought, if you agreed, disagreed, and if you have anybody that is having this conversation with you, send these videos out. We would appreciate it, and we will see you guys on the next video.